Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching the channel. All the comments and subscribers, I greatly appreciate it. This week, we're going to take a look at Bath & Body Works, a stock I think is worth $100, trading for $30. You can make 3 times your money on this stock and get paid a dividend while you wait. We're going to rip through the financials, figure out how much hard cash money this stock makes. You ready? Let's get to work. Let's review the 5 key attributes that we on this channel use to evaluate all of our stocks as kind of an entry point for stocks we want to consider. Number 1, top line revenue growth. We want revenue to be growing, period. Number 2, EBITDA. EBITDA, enterprise level earnings must be growing. None of this EPS growth only stuff. We want enterprise level growth. Number 3, strong free cash flow. Obviously, that's the point of the channel. Number 4, low debt. Less than 3 times debt to EBITDA is what we're looking for. Number 5, a well-priced stock. What is a well-priced stock? Well, it's going to vary depending upon all kinds of things. However, the main criteria is if we give a conservative growth rate to the stock over the decade, it should beat the stock market. That's what we want. We want a stock that we can buy at a low price, hold it for a long time, and we outperform the stock market. That, in our definition, is a well-priced stock. Now, as we dive into Bath & Body Works, there's some history here we need to understand. Lbrands, which was the parent company and was public for many, many, many years, owned 2 companies, Victoria's Secret and Bath & Body Works. In April 2022, those 2 companies split. Bath & Body Works, Lbrands became Bath & Body Works, and they spun out Victoria's Secret as its own separate company. So what this means is the data that we have for Bath & Body Works itself is limited. You have to go either back in history into Lbrands 10Ks and look for the sectional material that says Bath & Body Works, or you can look at the very recent quarterly filings for Bath & Body Works as a public company, but you cannot get large-scale historical financials on Bath & Body Works because it was buried inside Lbrands, and Victoria's Secret was doing terribly, and that was weighing down the company and this stock. So now, the reason I think it's very interesting is now it's public. You can buy as a pure play just this company, and if you're willing to do just a little bit of research, aka read the 10Ks, you can find, I think, a very compelling value stock. Let's go through the financials and figure out what we have. Now, Bath & Body Works financials. What we're doing here is we're pulling these financials for specifically Bath & Body Works outside from the 10Ks from Lbrands itself. Reading through the 10Ks, pulling out the sectional information where they talk about revenue. And we're pulling revenue and unit stores, which we'll get to in a second, for the material. So this is actual revenue for Bath & Body Works that we find inside the Lbrands, and I've labeled this historical and financial information just specifically for Bath & Body Works. $2.9 million of top-line revenue in 13. The fiscal year, by the way, is January 2029, so this is going to say 2021. This is January of 2022 and back 12 months. This next January 2023 will be released the financials for 2022. A little confusing there, but let's go with it. So in 2013, just under $3 billion of top-line revenue growth, and that has grown to 3.3, 3.5, 3.8, 4.1, 4.6, 5.2, 6.4, and 7.8. Every single year, they have grown their top-line revenue growth. Top-line revenue, fantastic, with a notable huge jump recently. Now, this is the COVID pop, right? So their online business exploded, their retail shop, apart from being closed for a long period of time, when they did come back, did very well because of stimulus money. So I think this is actually coming down a little bit, but long term, I think this pattern is continuing because they're building this per store count. We'll get into that. I think this checks the box on revenue growth. Now, EBITDA here for us is somewhat of a guess because we can't separate out the financials completely from Lbrands, but we are estimating that their financials, that their EBITDA growth is here, and we're doing that on a margin basis. We'll get there in a second. So $678 million of EBITDA in 2013, and that has grown to $2.2 billion of EBITDA in 2021. We're also footing this kind of level with their current quarterly numbers. And so that's showing that there's a roughly 16% increase in the EBITDA of the company over time, annual growth rate of 16%. Revenue's been growing at 13%, with the notable increase here of the COVID pop with stimulus. So we think that's going to be tempered a bit, but it does check the box for us. Now, let's move forward and see what else we can do. We can't do a whole lot, frankly, because the company has been buried inside Lbrands, and because the debt of the entire company is intermingled. It's very hard for us to determine what piece of debt belonged to Victoria's Secret and what piece of debt belonged to Bath & Body Works. But what we can do is we can pull the most recent financial statements, certainly the quarterly numbers for Bath & Body Works itself, and we can tell that they have currently now $6 billion of long-term debt. And we want to measure debt. Debt is a point-in-time estimate, so it's most important to have the most current debt. When we're looking at revenue and EBITDA, that's over time. You're looking for patterns, so you want long history there. We can. It's sufficient to have one data point for long-term debt. We don't necessarily need the pattern here. We just want to know the most current amount of debt that they have. They're obviously public, so we can take the average shares they have times the price that we have, $16 billion market cap. And I add these two up, it is $22 billion enterprise value for a company. And the last fiscal, as of Jan, they were trading at 10 times EBITDA, and they've got a 2.7 times debt to EBITDA ratio. This debt to EBITDA here is below our 3x, so it's going to be it's going to check the box for us. And the 10 times gives us kind of like a benchmark of what it valuation back then. If we looked at Lbrands itself as a conglomerate over the history, it would trade around 10 times when it had Victoria's Secret and Bath & Body Works combined. This is just showing just the data, just trying to pull out what is relevant for us in Bath & Body Works. Let's take a look at cash flow. Okay, cash flow is more difficult. Cash is what's called fungible. If I take $1 of earnings and I deposit it into my bank account, and I have two different businesses, I can't tell which, once that cash is deposited into a bank account that commingles funds, I can no longer tell where that cash came from. And as a result, the cash flow statement that I have here is the Lbrands historical cash flow statement. I cannot pull apart cash flow from operations for Victoria's Secret versus Bath & Body Works. It's impossible. You can't do CAPEX. To some degree you can, but largely no. Debt payments, definitely not. So all I'm trying to do here is just show that there is a historical pattern of producing cash. They did make cash as Lbrands, but it was not nearly as strong as this beast underneath it, which was carrying the company. So here's your cash flow from operations. Mild weak growth with the pop basically here. This is essentially flat for a long period of time. Pop with COVID gives you the 4% annual growth. Really not much to speak of here. CAPEX was declining, I'd imagine, because they were struggling with Victoria's Secret as a brand. They're reinvesting less in the infrastructure. Debt is what it is, so forth. Shares, you can see they were buying back some shares, just a mildly, so that is possible for them to buy back shares. And then a yield. Basically, it's very difficult for us to use this cash flow material, and I think that's one of the reasons why this stock is very interesting, because if you do a little bit of digging, a little work, you can pull out something very interesting. Okay, that's the historical information from what we can glean from reading the 10Ks. Now we need to break down the business of Bath & Body Works. We're going to start with where their revenues derive from. U.S. and Canada store retail sales, physical sales in the retail stores, $2.8 billion to $5.7 billion over this period of time. That's grown at 4% on average. If I look prior to the pandemic, 8% if I include the pandemic growth right here. The big one is online sales. So online is growing 18% annually, pre-pandemic 27% with the COVID bump. That's going to be a big driver for them going forward. And then you're going to see international sales are brand new, essentially 3 years old. If we look at this on a percentage basis, where do they derive most of their revenue over time? So if each year is 100%, U.S. store retail 93%, retail 7% online. What I think is very interesting here is look at the online growth. That's fantastic. Why? Well, online growth is going to have a little higher margin. Don't have to pay rent for online. Really interesting. So that you might even see margin growth in this business over time. This is declining, but only as a percentage of revenue. It's still growing, just not growing as fast as retail. Okay, the next thing we need to look at is the per store revenue. What are they doing in the per store count? So here's U.S. and Canada the total stores. Here's the change. So every year they're opening maybe slightly double-digit stores. What I like here is the revenue growth. $1,740,000 per store has grown over time to, in a pandemic high, $3.25 million per store. That's pretty huge. We're going to normalize that and bring that down in the forecast, but we'll get there. What I like here is that not only is the unit stores growing, but the revenue per store is also growing. That's fantastic. So you've got your per store growth here, very weak, very single digit growth, but pricing power, moving the volume per store, raising revenue on a price per unit does work for them. So they're kind of defending inflation, if you will, on a price per store growth. I like that a lot. And if we forecast forward and kind of string this business forward, what do? Well, I said, look, they're going to open 9 units a year. That's pretty conservative. They did 27 in 1 year, 21. I mean, I think that's reasonable. I'm going to haircut the revenue per store back down to pre-pandemic levels. So I'm going to say they're going to take a haircut in the revenue per store, and it's going to be flat for a year before it begins to grow. And I'm going to grow that at 3% over time. So revenue growth per store will grow at 3%. My US and Canada retail present location will grow at 0.5%. Super slow. And they have expressed that there is weakness in the shopping mall, and they are moving from inside shopping malls to standalone retail centers. So there's still a retail play here. It's just shifting from inside a retail mall box, into a standalone freestanding store. Okay, here's the international count. And I believe I said earlier that international sales are relatively new for them. That was not right. It was new when they started breaking out and reporting it. They had stores internationally for a while. So 38 stores back in 2012, very, very small, but it has continued to grow over time to where you see it, where I was reporting it earlier, 275 stores, and it's grown to 338 stores. Well, we think that's going to continue to grow. The international presence for them is a big, big market. They should continue to grow. So we're saying, hey, in the 50-60 range per unit over time, they should be able to build, and a revenue per store about $840,000, and then it'll grow a little bit at a 5% annual rate over time as revenue per store grows, and the per store growth for revenue. Now we get to online sales, the last component of their business. So here's the direct sales they call in their 10Ks, their online sales, and the growth rate that they experienced for direct sales. So what we're going to say is we're going to haircut that 15%, bring that back down for a post-pandemic level. I'm going to keep it flat for a year to give me some cushion, and then I'm going to grow it at a small double-digit number, 11% over time, to build that revenue piece up. And so basically doubling from 1.6 billion to 3.7 billion over the decade. Okay, we just covered a lot, and I want to review this in a simple chart to show you where the revenue is coming from and where the EBITDA is coming from. Historicals through 2021, forecast 2022 going forward. And you can see US retail, the lion's share, 93% of total revenue over here. But as the online business grows and as international grows through 2021, this is actual number, almost 10 billion. This is what they generated on a per revenue basis for total. And that growth, I think, will continue in the future with a kind of reset as we all experience this reset in the financial market. Well, I'm going to bring that back down and then continue their per store growth out in the future. All right, now we get to consolidate the numbers. So we have those 3 business units, US and Canada retail store sales, online sales for US and Canada, and we have the international store sales. So I'm gonna combine that for a forecast of $6.8 billion of next year, 2021, which we're almost, 2022, which we're almost through. I'm going to weak growth that, if that's a term. I'm going to give it weak growth. 6.9 next year, but out over the long term, as we continue to scale, you should get 11 to $12 billion of top line revenue out 10 years. Now the margin for the business, we can project the margin looking at individual business segments, US retail, international retail, and in online retail sales. And we can estimate that by consolidating it and looking at it as a whole. What was it relative to what they produced previous years? And what we're doing is we're giving an EBITDA margin to each section, with the online retail section having the highest margin, and that causes a margin growth over time. So we pick up with 1.7 billion, 1.8 billion forecast EBITDA next year, and that's going to grow to 3.1 billion over time. On a cash flow basis, now if we look at what Lbrands itself would produce on an EBITDA to cash flow from operations basis, we can use the same percentage to guess at what we think cash flow from operations will be. And that's what I'm doing here. Let me just fix this standard. What we're doing here is just saying, hey, look, this is about 70% of EBITDA turns into cash flow from operations when they were consolidated at the Lbrands. We think that's a prudent number, so we use that going forward. CAPEX is a ratio of cash flow from operations, and we check this with what Bath and Body Works says they're going to invest next year, about 330 million for store growth next year. We think that's fine. Debt payments, there are none because debt itself is less than 3 times, so they might borrow, they might pay down, but overall we think it's going to net out to zero as they maintain that level of debt. So that means that we think they'll produce $917 billion of free cash flow next year, just shy of $1 billion. On a per share basis, it's $3.97. Now we're going to consolidate this forecast and give you a price estimate for what we think Bath and Body Works would be worth. So here's the EBITDA number we produced earlier after the buildup of all the units, $1.8 billion. That is a 20% haircut to what they produced last year. We think that the COVID bounce is going to come down. So then we're going to keep it flat the following year. But over time, it should grow. And it should grow at mid-single-digit numbers on a combination of retail store growth and price increases over time. We think this is 3.1 billion out 10 years of EBITDA. Now, if I apply a 9 times market multiple, which is less than it traded in the past, and a very cheap multiple for a stock such as this that is growing at an 8% rate or so out in the future, that gives me a $28 billion valuation. If I back off a little bit of debt, I get a $26 billion market cap. Dividing that by the shares outstanding of 231 million, I get a $113 price target for Bath and Body Works out 10 years. Okay, let's do the same thing for free cash flow. Remember, we took EBITDA. We said EBITDA will translate as a percentage to cash flow from operations, about 70%. We're then going to reinvest that they're saying about $400 million into the business for CAPEX. We're going to haircut that down. No debt payments, divide by shares, and I get an estimate of what free cash flow for this business is. And again, you cannot get that by looking at the historical financials because cash is fungible, and you can't break out the cash flow statement for just Bath and Body Works, not historically. So we have to build it from what we think EBITDA is and come down into free cash flow. So that's just under $4 free cash flow per share, and I'm going to grow that similarly at the same rate as EBITDA because I think it's going to translate directly through. I'll give that an 8% yield, free cash flow yield, which is a high yield. So a lower stock price, $90.05 out 10 years as an estimate. I think this number could be higher if the yield were to be in the 6% range or so, more growthy, you get $120. So I think you're in that $90, $120 range for a stock that's throwing off good cash, growing per unit, growing store revenue. There's a lot to like here. Let's take a look at what it's trading at currently. Okay, we have 2 price estimates for Bath and Body Works. We've got a free cash flow method where we said it's $90, and we have a market multiple method, which is $113. Average it for, call it $100 a share. What is it currently trading at? It's currently trading at $36.50. Did you hear that? $36.50. What we can do is we can buy that stock now, park it, put it away, and then over time, as they grow per store basis, as revenue per store grows, as the capital markets recover, it should turn into $100 per share. Now, if I look at some other metrics here, so the current enterprise value of this company is $10 billion. That's taking this current share price, making it into an enterprise value. If I look at the forward EBITDA, remember this is the reduced EBITDA that I'm projecting, it's trading at 6 times. That is very cheap. That is too cheap for a business of this size to be trading at 6 times EBITDA. If I look at a free cash flow basis, it's projected to yield just under $4 of free cash flow. At the current share price, that's a 10 or 11% free cash flow yield, which on this channel we don't see very frequently. And when we do, the stock tends to run up higher, and that free cash flow yield comes down as the price rises. So I think this is a very interesting stock. I also think there's a couple other opportunities I did not cover in their 10K, which everybody should be reading. Don't buy a stock without reading through all of this material. They talk about other growth strategies, that they want to continue to build in their men's line, that they had a lot of success there. They want to double down in their online business, which I think is very strong. And there's also a possibility here where they can expand into other lines of business, like hair and makeup, or other wearable cosmetic products, not even cosmetic, but other products that are analogous to candles, fragrances, lotions, those kinds of things, perfumes. So there's a lot of other stuff they can do. They can either buy a business and directly have a brand they can plug into their retail network. That's one. Or they can simply continue to expand their product offering, product lines. Both of them, I think, are very, very attractive, and would be, I would hope, certainly an acquisition would be an acceleration of this type of forecast. All right, let's drop it into an IRR and see what we get. So I get this pro rata share of ownership. Remember, this isn't a dividend. This is my pro rata ownership of a stock, buying a single share. I own a piece of the total business. This is my piece. I bought this piece for $36.50. I'm going to sell it out 10 years for $100. That is a 24% compound annually growth rate, which is a phenomenal growth rate for your portfolio over a decade. And I would highly, highly encourage you to take a number that's reasonable for you, say 10 grand, 50 grand, whatever reasonable for you is. Put that in a financial calculator, 24% interest for 10 years, and see what that turns into. It's quite a nice number. Well, I mean, it says here $118 is your cash. Well, we'll skip that. So 24% is a very high compound growth rate. It also beats the stock market. On average, the S&P 500 index over any 10-year period of time has done 10%. This is 240% higher than that. I think that's a very good risk-adjusted rate of return for a business. So let's review the 5 key attributes. Number 1, top line revenue growth. Yeah, check the box, it's growing. Number 2, EBITDA. Yes, strong, growing, check the box. Number 3, strong free cash flow. Absolutely, cash flow is very strong. Number 4, low debt. Yes, less than 3 times debt. And number 5, well priced. Yes, it is well priced because it's yielding a high, very, very high return expectation relative to the market on what I consider to be a very conservative forecast. Low single digit, actually less than 1% per unit store growth, a 3% or a 5% revenue per store growth, depending on international or whatnot. So in all, you're looking at a low single or mid single digit EBITDA growth number that they need to achieve, which they have been doing historically. Here, right? So I think that EBITDA growth rate is very realistic for them. And given that it still produces a return of 24%, I like that stock a lot. And that's why I wanted to wear the trifecta t-shirt today. Why? Because I think this qualifies as the trifecta. Number 1, you've got earnings growth. EBITDA is growing conservative over time. Number 2, your market multiple expansion. You've got this, you're buying the stock at 6 times earnings here. And I think I can sell it later on in the future at 9 times, or it's traded historically at 10. So that means every dollar of earnings I buy at 6, I can flip at 9. That's exponential. And number 3, share buybacks. They did them in the past. Now that they're a standalone company, they just did their equity plan, which is written in here. I think given the stock price it's currently, given the cash they have, the low debt, they could come out of the gate with a stock buyback program to start scooping up those shares at a discount. Which would give us the 3 components that we need for that hockey stick curve that produces a compound and exponential growth rate. Go back to my video, Domino's versus Google. Domino's IPO'd at single digits like this over a 15-year period of time, kicked out a dividend, bought back shares, and this market multiple expanded to about 50, almost 20 times now during the pandemic. And that produced a hockey stick curve that beat the return of Google for 15 years because Google IPO'd at 20 times multiple. It's still at 20 times multiple, never paid a dividend, and only got the price gain for the stock. Whereas Domino's gave you dividend, you bought more stock with that dividend, they bought back their own stock, and the market multiple expansion. Those things compounded to magnify the growth of Domino's that was not apparent in Google. So don't throw out tiny conservative companies such as a Bath and Body Works. I love the business. I think it's very simple. It's making candles and fragrances. Yes, the space is crowded, but it's a very big space, and they have a great brand name. So, anyways, I give it no secret here. It's a good in the rating. Definitely check it out. I want to take the minute to thank everybody. Please hit the like, throw a comment down below. It really helps me on social media with the algorithm. You hit that like button, toss a comment down, greatly appreciate it. Let me know what else you'd like to see. I'm happy to do other stocks. I do want to plug my cash flow club for a second. So if you look in the description down below or go to my website, cashflowinvestingpro.com, you can join the cash flow club. And it's a club where I release one-page reviews of stock such as this one, where I give you 10 years of historical financial information. I call out the 5 key attributes if I think it qualifies. I give you the forecast on EBITDA and free cash flow. I give you the IRR and type up notes. And we are kicking out, me and the analyst team are kicking out more and more one-pagers every month, far more than I can do on YouTube itself. And there are a lot of very attractive buys in the stock market right now. I think also that's going to continue. Do not buy this dip. I think you wait. And continue to let the Fed try to kill inflation. Doing that's going to kill the economy. And there's going to be a lot of asset repricing. But buying things 6 times like this and waiting, that in my opinion is a bottoming of the price, and it has great value. Last thing, if you're interested, and in the description you can find a free cash flow one-pager by following the link. Really appreciate that. It supports me. I really appreciate it. Number 2, if you want to learn to be a financial analyst, I do teach a course on how to become a financial analyst. And what you can do is go to the website, cashflowinvestingpro.com. In there, I will teach you how to be a financial analyst. I give you this Excel template. We go through Apple together. I walk through the 10Ks, how to identify revenue, EBITDA, how to build up debt. What do you do if the company splits shares or reverse splits? How do you counteract that and make sure you're looking the right share price with the right share count? We build a forecast together, show you market multiples, yields, and how to build a portfolio of a few stocks that over the long term will compound your wealth and get you where you want to go. It's not hard, it just takes time. And most people want to chase the high flyer and are not willing to wait. But if you're willing to wait, the odds of you becoming wealthy increase considerably if you take your time, buy right, and hold forever. That's my plug for the course. Check it out. I really appreciate the support there. Thank you very much. This has been Bath & Body Works. I like this company, as you can see. I think it's a simple business, and hopefully the new management team coming in there can really turn this business, and now that they're finally out from underneath the Lbrands, they can start reinvesting their own capital into their own business rather than having to support the failing Victoria's Secret brand. And I think that's why I like this. So again, last comment of the day. Thank you so much. Read the 10Ks. There are tremendous companies out there that have great value that nobody reads this material. And if you just sit down, print it out like I do, keep it in your backpack, flip through it every free chance you have, and you will, over time, discover fantastic companies. This is Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. Up is going to pop a couple videos of other stocks that I've reviewed. Definitely check them out. And I hope you like the stock where I think you can triple your money and get paid a dividend while you wait for Bath & Body Works. Thank you. Take care. Bye-bye.